So this is probably going to be the next and also probably the last episode of The Intelligent Investor by Benjamin Graham. And today we're going to talk about the enterprise investor, which is like the more aggressive person and or the more aggressive investor compared to the defensive investor. But yeah, there's going to be more after the intro as quite always. And I'm really happy to record this episode. And I'm also really happy to go ahead with this summary because I still believe that it is something that's relatively important to just know slightly about. Because this is particularly not just a huge summary. It is just something. It is just a few bits of information, which is, at my point of view, like not really enough. You know, it's not enough, but I think it is a pretty good basis and also pretty good way to spark interest, I would say. But yeah, let's see. The enterprising investor, whatever enterprising actually means. Resourceful, imaginative, ingenious, inventive, original. The quote-unquote aggressive investor will start from the same base as the defensive investor, but will also branch out to other kinds of securities if proven to be attractive as established by intelligent analysis. Remember, if you bring just a little extra knowledge and cleverness upon your investment program, instead of getting a little better than normal results, you may find that you're eventually done much worse. If you just bring a little extra knowledge. Yeah, you know, I think it just says that we are often overthinking things and that we often think that we are the smartest and that we are the best, but we are not. You know, especially when it's about like the stock market, something that nobody is able to break. Yeah, I'd say, you know, this is just what I'm thinking about. Graham lists his stones for aggressive investors. High yield bonds, whatever they are, I don't know. As I said in the other episodes and probably the most in the last episode, I don't really know anything about personal finance more, but I should just not know about or that much about the stock market and the specific termines and all these things. I hope they're called termines because they're called like this in German. Or are they not? I don't actually know. The second one is the Voreigen bonds. May be appealing if you can withstand plenty of risk. And the third one is day trading. Holding stocks for a few hours at a time. The more you trade, the less you keep. Instead, an enterprising investor should focus on buying in low markets and selling in high markets. A great company is not a great investment if you pay too much for the stock. Carefully chosen growth stocks. Look into growth stocks not when they are at their most popular, but when something goes wrong. Various bargains, which is actually kind of a negative way of thinking, I would say, because then it's everything about like, is there going to be something that... Is there going to be something that... Wait, no. Is there going to be something bad? Quite, you know, or just hoping for something bad to occur, so just that you can grab stocks for a very low price or for a lower price. Yeah. Well, anyway. The third one is various bargain issues. Temporary unpopularity creates lasting wealth by enabling you to buy a great company at a good price. Truly the case, you know, because I guess when something is temporarily unpopular, then it is something that's quite low in price. You know, even though it's like Apple, even though it is like an Amazon, even though it's like a Coca-Cola, even though it's just a quite big corporation that's probably going to go up again. And probably, so I don't know, but I mean, I do have to say, like, I actually don't know about Coca-Cola since I don't know how society is going to shift in the next few years, you know, because, I mean, if there's more people that are just going for a more health concerned or health oriented diet, then I don't know if they're going to make so many profits along the way for the next few years. But I mean, like Amazon is, I think, like just one of the companies where I somehow can be sure that the price is going to go up because they're doing so good things, because they're thinking about their customers and they're truly and really just also develop products for their customers. You know, it's not, they just do everything for the customer. You know, if something is inconvenient, if something is just bad for the customer, they're going to either change it or not even make it. So therefore it's like, yeah, you know, it's probably going to be the case that they're going to be huge in the next years, or that they're going to be fine, at least in the next years. Even for aggressive investors, however, it is worth repeating. Selecting individual stocks is unnecessary, if not inadvisable. A small percentage of investors can excel at picking their own stocks. Yes, good investors, I would say. Everyone else would be better off getting help, ideally through an index fund. If you insist, Graham advised investors to practice first. Start off by spending a year tracking and picking stocks, but not with real money. By test driving your techniques before trying them with real money, you can make mistakes without incurring any actual losses. Develop the discipline to avoid frequent trading, compare your approach against those of leading money managers, and learn what works for you. If you didn't enjoy the experiment and your picks were poor, no harm done. Get yourself an index fund and stop wasting your time on stock picking. Yeah, sure. I don't know if this is having something to do with just being proud of it and being like, well, I know what I do and I'm such a smart person. I've just studied the stock market for several years, so I'm going to be able to just pick the stocks. I don't know, maybe, probably even. But I don't know, just go for an index fund and just buy it all the time and just wait till it is going up until there's a lot of money in it for you. If you enjoyed the experiment and earned sufficiently good returns, gradually assemble a basket of stocks, but limit it to a maximum of 10% of your overall portfolio. Keep the rest in an index fund. And remember, stop it if it no longer interests you or your returns turn bad. A last note on being an aggressive investor. Ultimately, financial risk resides not in what kinds of investments you have, but in what kind of investor you are. Risk exists inside of you. Which is, I think, a pretty cool statement and a pretty interesting statement as well. Because I also believe in it, because I also think like that, because, I mean, if you do not want to be risky, you don't have to. Like, there's nobody saying that you should be risky or something. And if you're not risky, then you're probably going to have relatively high returns over a relatively big time span, which is good, for most people, I would say, or most people are fine with that. I wouldn't necessarily say that most people are just really trying to pick their stocks or whatnot. They do just want to accumulate some wealth, and if this is just a way to do so, and seemingly a relatively easy one, even though this is something that I heavily doubt that it is the case, then why not? Why really wasting the time and just picking your stocks and trying to be somebody and whatnot? But actually coming back to that and actually just talking about that, I don't actually know. I don't know if it is actually going to make you rich. I don't know how the chances are. And I mean, of course, there's some what are they called? Compound interest calculators. And if you calculate okay, you're going to pay every single month, I don't know, I think it's been $300. He said 500, but I've calculated it with 300. And your initial investment is I think $1,000 or something. Then you're going to have, after I think 50 years, it's been, I don't know, I think 500K or something, or 100K, 120, something like that. So it's probably going to be some money. But of course, the more money you make, the more money you are able to just put into the whole system, which means that the more money you put into it, the more money you will get out, basically. Unless you're just really trying to steadily do that and you're not rebalancing whatsoever and you're just buying the same amount of stocks, or you're buying the same amount of stocks with the same amount of money, which is not going to work out because sometimes they're more expensive and sometimes they're not. But you're going to get so you're going to get more stocks or less stocks in the end, as they also said in the last episode or in the last part that I've gone through, that we have gone through. But yeah, maybe it works. I do just heavily want you to research this on your own. I do not want you to just make any decision based on whatever I've gone through. I do just really want you to research that, since it is actually a relatively old book. Quite old. I don't know, actually. The Intelligent Investor. But it is a good book as far as I know. And also for the whole thing by the whole one. And it's a book by 1949. So I don't actually know how much it changed, or how many things changed since I kind of believe that not so many things changed. And it is 640 pages long as far as I can see. It's a widely acclaimed book on value investing. Yeah. Publisher Harper & Brothers. Cover artist Donovan Hayes. I do wonder if he did also something else, and I'm actually going to show you here. Scholarship articles for Donovan Hayes P. Donovan Hayes on Pinterest. I do wonder. He's probably also relatively old, I guess. Well, not quite sure if this is the right one, but maybe it's the LinkedIn page here. Marketing major and aspiring entrepreneur. Kind of looks like Obama, but it's not him either. Designer? Design. Jonathan Hayes design. Jonathan. What's the right one now? Well, anyway, so please just do the research and please just look for information. If you want to know what risk really is, go to the nearest bathroom and step up to the mirror. That's risk. Gazing back at you from the glass. Oh. So risk seems to be you, I guess, then. Because when you look into a mirror, then it's you. It's you that you're seeing or what you're seeing. Quite. I know. It took a little time until I've got it. But it could also be something different, so I don't actually know. Successful investing is about managing risk and not avoiding it. And I do have to say, by managing risk, I think it is not about trying. It's not about just having only high risk things. It is going to be about managing it. It's going to be about just having low risk thing, and it's going to be about having high risk thing. And there's also going to be something in between, I guess, and I assume. But it's not going to be just only about high risk and high reward. And it's probably also not only, it just depends on whatever you're doing. If you're this type of investor or the other type of investor. And I think that you're not only going to have like just low risk and low return. I know that just might be something like a combination of both. I would just, for me, it is totally fine to have like just some index fund, and I'm just basically paying for it in the next 20 years or something. And then I'm going to basically have some money probably, with 7% return. It depends on how much money I put into it. But I do, by the way, let's actually calculate that. Compound interest. Because I do actually want to see that. If it is actually like 7%, I think it's been 6.5. Calculator, moneyjump.com. Current principal, 0. Annual addition, what is 500 per day times 365? No, it's not per day, it's per month. Well, I'm actually very sorry that here you are. 500 times it's per month, so it's going to be per 12. Is it? Which is 6K then. Is this right? Has it been per month? I think it's been per month, yeah. 6K. 6, 1, 2, 3. Years to grow, 20. Interest rate, 7%. Let's go for 6.5. 6.5. Oh. 6.50. Compound interest 1 times annually. I don't know if it is, but probably. Well, make addition at start, end of each compounding period. On the start, I'd say. Calculate. $248,093 by having 6,000 times 20, which is 6 times 20 is 120, which is going to be 120,000. Am I right here? I don't actually know. 6,000 times 20. 120,000. So you're basically doubling your amount of money by basically doing nothing. But if, let's say, it is a 7% interest, calculate, then it is already going to be 260,000. But if you just stack it up to 10K per year, it is going to be much more. It's going to be 438,000. Yeah. But if you just stack it up to 100K a year, I don't know if it's possible to do that, then it's going to be 4 million. But I don't know if it is that smart to just have 100K per year for 20 years in index funds. So there might be something else that's smarter than to do that. But yeah, let's keep it at the 6,000. And let's just see what the end of compounding period is basically. Oh, I see. Well, yeah, so what we see is that it's only 20 years, which means that if we pull it up to, and I'm very sorry, not to 500 years, but to 50 years, then we're going to have 2.6 million by adding $500 per month steadily. You're not increasing it whatsoever, but it is steadily $500 per month, which is still something. Don't get me wrong. What about 3K? Might be more workable for some people. And after 50 years, you're going to have $1.3 million. Basically, you know, if everything runs as smoothly as it should, then you're not going to be rich, but you're having quite some money, I'd say. The conclusion, the key takeaways. We invest because of inflation, which erodes our wealth. An intelligent investor is patient, disciplined, and eager to learn, harnessing their emotions and managing risk and fear. Stocks become more risky as their prices rise and less risky as they fall. By refusing to pay too much for an investment, you minimize the chances that your wealth will be lost. A 50% bonds and 50% common stocks approach makes good sense for a defensive investor. Hold an index fund for 20 years or more, adding new money every month, and you'll outperform the vast majority. Further readings, I Will Teach You to Be Rich. I don't know the author, unfortunately, but I could look it up pretty quickly so that you might know, because I think that I've already went through it as far as I can tell. No, I do wanna... Okay, I do not wanna... Oh, by Ramit Sethi. If you know him... Oh no, I've just fucked up right now. Let's go back. And the other one's been Unshakable. What's wrong today? Unshakable by Tony Robbins, or Anthony Robbins actually, which is also a pretty good book since he interviewed a lot of people, especially also Ray Dalio, who is a really big hedge fund manager with this company Bridgewater, yes. And yeah, then there's the other one, which is Guidelines, which is the book by Paul Miners, which is the author of the site here, which is basically a summary of 33 of the best self-help books. Yes. And it is 80 pages long, and it is also a 115-minute audio book. The action steps. Identify your appetite and endurance to risk. Consistently set aside a monthly lump sum to invest in an index fund. If an aggressive investor, experiment with 10% of your investment money on picking your own stocks. And the last one is download the complete book on Amazon, or just buy it as a printed version, whatever you prefer most. I do wonder what personal finance is all about. All posts tag personal finance, the intelligent investor, why I'm buying Bitcoin every week. It's actually from 2019, and it is an article by him. How you can make money online within this month. I do wonder what he says there. I don't know if it is a podcast. Maybe it is. It is a podcast. But maybe it's also different ways of earning money online. Digital products. Yeah, okay. Affiliate marketing. Classic. Pat Flynn from Smart Passive Income, who I highly recommend you to check out when getting started, earned the bulk of his income in the early days from referring people to purchase hosting services from Bluehost affiliate links. Display advertising and sponsorships. Another great way of earning an income online is from display advertising or sponsorships. Display advertising refers to the banner ads you see on websites, but to do that, you basically should also have a website that is like big. Consulting or freelancing, yeah, it's not easy, but it might be worth it. I earned a little over 1.4K by teaching people how to use Asana for affiliate link. Another great benefit is that by providing a service, you can lot about customers. You can learn a lot about customers' value, which will help you later if you decide to create and sell digital products. How to make your first few $100s in this month. Upwork and Freelance Clarity. Yeah, you can freelance, but it's not as easy as all the people say it is. Because I've also looked at it, of course, if you just make it your full-time job and also your part-time job, if you really just put a lot of work and time into that, I think you can probably do something. I really do think. If you're just sending out the most proposals and whatnot, then it's probably going to work. But it's not like, okay, I'm going to just sign up for this platform, then I'm going to just type in what I'm able to do. I'm not the best, but I can do something. And then I'm going to get some clients, and then they're going to pay me for doing some shit work. It's not the case. There's a lot of competition, especially when it is all about prices. Because it's going to be about the lowest price. And if you're having the lowest price, it doesn't necessarily mean that you're going to have just clients and shit. Because money is also a way to tell a story. It is a way to market your shit. And I mean, if you're just pricing it as low as possible, then of course some people are going to come. Some people are going to come, but not everyone. And some people are gonna just prefer somebody that's more expensive and or is having more experience than you, or some different and various other factors, maybe even your profile picture, if this is something they can see, but I don't know. So anyway, this is gonna be the end of the episode. I really hope that you've liked it, and I really hope that you've just learned something as well. And I'm hopefully gonna see you the next time. So I wish you the best health, happiness, and also success, and also hope that you're going to remind yourself and you're going to be remembered, which basically means your legacy, and basically means just being a nice person and then being remembered as a nice person. 3 other questions that I'm having for you are: why are you here? What are you trying to change? And what is bothering you the most? These 3 questions are hopefully going to show you your purpose and maybe even a business idea. So yeah, gonna see you the next time. I at least hope. Thank you very much from the bottom of my fucking heart. I appreciate that such a lot, that you're here and that you're, even if you clicked on the video, even if you just watched, 10 minutes of it, I am so fucking grateful for that. You don't even know. Well, now you know, bah. Thank you. Really, really, really thank you. And I hope that you're healthy. I hope that you're feeling good. I hope your family is fine as well. And I'm hopefully going to see you tomorrow. So, bye-bye. Have a good day.